Hello friends, last week in my video we discussed whether the rate cut would provide any kind of a sentimental booster to the market, and I told you that a 0.25% rate cut was not enough to basically turn the sentiments around in no uncertain terms. Now this week we are going to discuss whether bulls are basically too far tired to revive sentiments, or is there going to be some kind of a fighting chance that the markets might just recover this week? Before I proceed further, please do take a look at this recent video which I have recorded, in which I have explained in great detail. It's a fairly long video about what the phalanx formation is, what the pincer is, how you should be going forward trading in the markets. That will help you formulate a strategy for the market going forward for the rest of the year, because this year 2025, as I've been telling you, is a year of pro-cyclical hysteresis in financial markets. So that said and that done, let's now go to our usual format of our weekly video. And coming up on your screen is the market roundup, the weekly roundup. It tells you that the decline was led by the broad-based Nifty 50, with the Bank Nifty bringing up the rear. The US dollar index fell pretty sharply, underwent a lot of profit taking, and that boosted the prospects of the rupee versus the United States dollar. And since the rupee, relatively speaking, firmed up against the dollar, the declines in our markets were somewhat cushioned. Otherwise, they would have been fairly deeper. Now, a falling dollar did not boost the price of gold, which tells you that there was some amount of profit taking at higher levels in bullion, and nor did it boost up the price of crude oil. Natural gas, of course, went up due to seasonal considerations, because winter is a time when natural gas is the fuel of choice for indoor heating. The Indian 10-year benchmark bond yield rose up just about mildly, and that tells you that bond prices fell a little bit, not too much. And the NSE market capitalization, now this is something that I worry about, fell over 5.5%. Now, historically, I've seen whenever the NSE market capitalization falls by more than 4% for 3 or max 4 weeks in a row, a very, very deep fall occurs in the market. So consider this as week 1, but 5.5%, frankly, is a very widespread decline. Now, MWPL, or market-wide position limits, rose, which is routine after expiry, and the US headline indices rose, thereby cushioning declines in our market. Friends, I now come to the ratio chart. This is Bank Nifty divided by the Nifty 50. Why do I focus on the ratio chart? Because of the table that you are seeing in the upper corner here. Now, the banking and financial sector space commands a humongous weightage of 34.35%. Not only is the banking and financial sector the swing sector in the market, and it takes the market wherever it goes itself, but this sector weightage is higher than the number 2, 3, and 4 sector weightages put together. So now coming back to the ratio chart, what you're seeing is this is the third consecutive week where the ratio has improved. But like I said earlier, I would ideally want this ratio to be at 2.35, if not 2.45. So at last week, Friday close of 2.15, we are way below, but relatively speaking, it is the Nifty which is falling faster than the Bank Nifty. So whenever the rally occurs with the same lockstep proportion, which means the Bank Nifty rises faster than the Nifty in case of advances, that rally would be a little more believable. Now, friends, I come to my in-house indicators. I start with the MWPL. This video explains to you what MWPL is and why, in my humble opinion, it's one of the most reliable and fantastic indicators that you can ever have. So, with the MWPL chart on your screen tells you that the market-wide position limits rose faster in the second week after expiry compared to the similar week last month after the December expiry. So that tells you that the retail guys are still nursing a hangover of buy the dips. They still think that markets have some kind of a chance of bouncing back as it has in the past 2.5 years, which they've taken for granted. Now, rising MWPL is a good sign that buying support is coming in, but it's also a sign of volatility because should anything go wrong, bigger positions will need to be unwound and therefore crowded exits occur. That means volatility goes up. So you need to be careful of that, please. Now, friends, I come to the stock and futures, index futures turnover. And this is 3 concurrent series. So it is Feb, March and April. The turnover in stock futures fell, whereas the index futures turnover rose just marginally. Overall, the turnover is fairly down. So retail participation is wanting. We would want the participation to be higher, but then I would not really blame the retail guys too much. They've been paying mark-to-market losses of late. Friends, I now come to the advanced decline ratio, which is after the price itself, the fastest leading indicator. And as the Nifty line, which is minus 2.68%, tells you, the index fell rather steeply. And so did the advanced decline ratio. At 0.39, it tells you that there were 39 gaining stocks for every 100 losing stocks. Clearly, intraday traders lacked the conviction to go out there and buy aggressively. Friends, I now come to the Nifty and Bank Nifty prompt month futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Higher is the premium, higher is the risk appetite, and vice versa. Basis, also like options premium, erodes as time passes by towards expiry. And what we are seeing is the basis of both the indices has gone up last week. Why? At lower levels, there was short covering. Now, this is one of the minor, you can't bet your life on it. This is one of the minor evidences that there could be some amount of cushion in the coming week. Early days yet, but let's hope. Now, friends, I come to our in-house exclusive indicator, the impetus. You won't find this anywhere on the internet. And what it tells you is the Bank Nifty fell last week. The impetus reading was down. But the Nifty 50 impetus reading was up in spite of the fact that the Nifty fell further. Do remember this as we proceed in the video. What does it mean? It means that there was forceful selling on the Nifty, whereas marginal selling in the Bank Nifty. Now, I come to our in-house exclusive indicator, a lift, weight, thrust, drag indicator. You've trusted it for over 3 years now, and it stood your expectations and stood the test of time. Friends, the LWTD indicator is quite simply at the lowest level it has been ever since I started plotting it. What does it mean? It tells me that fresh buying support on declines will be very, very mild. And of course, short covering can be expected due to any news flow. If there's any news coming in from US policy with India, any announcement on the trade and defense deal front, etc., etc. But short covering can only cushion declines. We need aggressive fresh buying to take the index sustainably higher. That has a low probability of happening. Now, all these in-house indicators, the impetus, the futures basis, the LWTD, etc., are updated on my social media accounts every day post-market. Do connect with me. My contact coordinates come below this video in the description and the pinned comment. Friends, our in-house indicators done. I now come to the bond market, which is very close to my heart. I've been analyzing bonds ahead of equities for many, many years because this is the source of money supply for other asset classes. What we saw in the initial post-market, the weekly market roundup rather, was that bond prices went up marginally, which means bond yields, went up marginally, which means bond prices fell a little. That tells you that check writers, and that's all that matters in this market because the guy who writes out a check, who deploys money in the market, moves the needles and gauges in the market. The check writers don't believe that interest rate cycle has peaked out. They don't expect very aggressive rate cuts in the absolute near term. So, any implications for you and me? Keep the powder dry. Don't deploy any money in sovereign bonds just yet. And let's also stay away from gilt funds. I assure you, whenever I start deploying money in gilts or 10YP, 10-year securities, I will be happy to update it on my social media accounts for you. Friends, the bond market's done. I now come to the bank Nifty. And as we've seen, this index has fallen relatively less than the Nifty 50. It surrendered 2.11%, as you can see on the daily chart on your screen. It fell on 4 out of 5 trading sessions last week. The price remained below its monthly moving average, which itself is pointed downwards. So the short-term outlook is negative for now. Though the index is above its recent swing low of 47,844, the selling on rallies is felt palpably so. Now, with a weightage of 34.35%, the banking sector is the sector to watch. Let's now move to the weekly chart on your screen, which shows a well-formed bearish candle, but that bearish candle is contained within the prior week's bullish candle. That makes it what the Dow theory calls an inside pattern. It signifies a smaller real effective range and possible indecision, which means follow-up buying action will determine which way the market wants to go. Now, the price is below its 25-week exponential moving average, which is equivalent of 6 months of holding on cost of an average bull. So, the medium-term outlook is also negative for now. The 6-month average itself is headed lower. In the week before last, this index was placed at number 5 on our statistical beta ranking that I maintain in-house. Status quo was maintained. It still remained at number 5. That's fairly high, of course. And last week, I advocated an estimated range between 52,025 on the upside and 48,275 on the downside, which held perfectly well. In the coming week, I estimate the range between 50,900 on the upside and 47,325 on the downside. The range is wide due to high statistical beta. Now, in addition to the range, please also watch the daily, weekly, and monthly pivots that I update for free on our free Telegram channel. Also, do not miss out on this free tutorial video, which helps you make the best use out of our pivot levels and helps you laser precise and time your trades even better. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 2.68%. And as the daily chart on your screen tells you, this index fell on all 5 out of 5 trading sessions last week. Now remember, the impetus on the Nifty was higher than the Bank Nifty. So selling is much more profound on the Nifty itself. The price is below its month-long moving average, which itself is pointing lower and has breached the swing low that this index made on 27th of January 2025. So relatively speaking, this index appears to be comparatively weaker than the Bank Nifty, which has not yet breached the previous swing low. The short-term outlook is negative for now. And moving to the weekly chart, what we see is a fairly large bearish power candle, which is much larger than the prior week's candle. The nervousness on the Nifty 50 is very clearly apparent. The price is significantly below its 25-week exponential moving average, which is equivalent of 6 months of holding on cost of an average trader. So the medium-term outlook remains negative for now. Friends, in the week before last, this index ranked 14 on our statistical beta rankings of volatility. It's climbed 3 notches. It's now at number 11. Now, volatility going up is never any good news for an average retail trader because he has to contend with the possibility of higher losses. Friends, last week I advocated an estimated range between 24,225 on the upside and 22,875 on the downside. I'm afraid our system, the IBEX, missed the bottom because the actual low was 22,775, which means the Nifty actually exceeded the lower level that I specified by 100 points. But then that was the kind of volatility that we saw last week. In the coming week, I estimate a range between 23,600 on the upside and 22,275 on the downside. Also monitor the daily, weekly and monthly pivots that we update on our Telegram and other social media accounts, and this tutorial video of how to make the best use of these pivot levels. Friends, I now come to the last bit of statistical analysis wherein I gauge the retail risk appetite by their footprint in the four derivative segments in the market. Now, futures demand more money and are more volatile. And last week, what we see on the weekly chart on your screen, the index futures turnover contribution went down by 2 basis points, is indicated as a blue line. Stock futures turnover contribution fell by 20 basis points, indicated as a red line. Traders are very clearly moving away from futures because they demand more money by span margin and mark-to-market margin. They are more volatile. And what are they doing in the options? Now, in the index options, turnover contribution went up by 58 basis points, is indicated as a green line. It was the only gaining segment. Stock options turnover fell by 36 basis points, indicated as a purple line. Now, between index and stock options are the least risky in the overall derivative space. They demand the least amount of margin in case you're an option writer. Also, the premium tends to be in percentage terms lower than stock options premium. So what does this tell you? Retail traders for sure were going long, but they were going long in the least risky, least capital intensive segment, which is index options. That tells me that the risk appetite is damaged. That's the only word I can think of. Now, friends, I come to my trading strategy for the week ahead. Theta decay, as I told you in that special video on pincer and phalanx, etc. Theta decay remains the workhorse of my prop trading desk. I'll still focus on interest rate sensitives, which I have been telling you for over a year and a half now. That remains my prima donna or number one sector that I'm watching. And since I've been focusing on this segment since over 18 months, I do not feel the need to reinvent the wheel because the current wheel is working so beautifully right now. Now, in day trades, intraday trades, I'll stick with public sector units. There's a special video that I've recorded over a year and a half ago about why I prefer public sector units, both for long and for short. I'm not just biased on bullish or bearish side, but these have some special characteristics which mathematical and disciplined traders will find a good appreciative quality to have in a particular stock. So do watch that video. Now, in commodities, bullion has seen sharp profit taking on advances, which is actually fine considering the parabolic rally that you have seen in the recent past. That kind of price violent move is very expected because the rally itself was so perpendicular. Now, the long-term story remains intact, and this video, which I have recorded for you about how to buy the purest bullion at honest-to-God prices, is something that you should see. At big declines, if any, I expect institutional support to come in to bullion. Now, industrial metals may just see month-end short covering, and that might just push up the metal mining company stock prices temporarily. But I'm using the word temporarily because higher levels are encountering resistance levels and selling. So upsides may be capped. Theta decay is another continued strategy of mine in the energy commodities space in the MCX. So I'm going to continue with the tried and tested methods, and in the fixed income, as I've already told you, I will keep the powder dry both in 10-year benchmark bonds and gilt funds. Friends, if I have any fresh ideas to share with you, I will gladly do so. on our free Telegram channel, the WhatsApp channel. Contact coordinates come at the fag end of this video and below the video in the pinned comment and description. Do make yourself familiar with this data which is available every day. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, I would love to hear what you think about our work and how we can record more videos of your choice to help you understand the markets better. A reminder and a request, please share my videos with as many of your social media groups, your friends, your family, your contact list, so I can reach out to a wider audience to spread the knowledge-based investment and trading culture within our country. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Have a profitable weekend. Bye-bye.